This is a preview video. Thanks for joining us at xm.com. We'll be looking at non-farm payrolls out this week and, of course, the outlook for the dollar. I'm Cristina Marujos. With me today is our senior investment analyst, Geralambos Pissouros. Geralambos, investors have been edging closer to the Fed's rate projections lately, but could this week's non-farm payrolls report perhaps change that pattern?
Hello, Cristina. Yes, indeed, investors have been scaling back their rate cut bets, and to be honest, they have been doing so notably. At the turn of the year, they were pricing in around 160 basis points worth of rate cuts to be delivered by the end of the year. And that number is now at around 85, very close to the Fed's projection of 75 basis points worth of cuts. And what's more, from fully pricing in a first quarter point cut in March, they are now assigning a 20% chance for that happening in May, while such an action is not even fully priced in for June. Now, the fact that there is still room for before the market matches the Fed's projections suggests that this week's events and data may attract special attention. Fed Chair Powell will testify before Congress on Wednesday and Thursday, but the highlight is likely to be the US jobs report on Friday. Now, with data since the latest Fed gathering pointing to stellar employment gains, a robust economic performance, and inflation not cooling as fast as anticipated, Powell is unlikely to deviate from its previous view that lowering interest rates is not an urgency. So the spotlight will fall on Friday's jobs data, where the forecasts suggest that the unemployment rate held steady at 3.7%, while non-farm payrolls are expected to have increased by 200,000. This is a slowdown compared to the stellar gains we got on January, and is supported by the S&P Global Composite PMI for the month, where job creations was broad-based, but the overall pace eased to the slowest in 3 months. Investors may also pay extra attention to wage growth data as they try to estimate where inflation may be headed after the CPI and PPI numbers pointed to stickier than expected price pressures during January. Now, for wages, expectations are for a slowdown to 0.2% from 0.6% month on month, which will take the year-over-year rate down to 4.4 from 4.5. This could imply that price pressures may continue easing in the months to come, but a minor slowdown in yearly earnings is unlikely to prompt market participants to bring forward their rate cut bets. Investors may even scale those bets further back if indeed the report points to decent jobs gains, and conditional, of course, upon Powell sticking to his higher for longer view the previous days.
And Geralambos, taking all of this into account, let's look at the market reaction. How could we see the dollar perform this week?
The dollar could strengthen if we get solid jobs gains and an only minor slowdown in wages, as investors may start questioning a June rate cut even more. And one of the better candidates which the dollar could outperform may be the Japanese yen, which on Friday resumed its fall after Bank of Japan Governor Ueda contradicted Takada's view that the 2% inflation goal is within sight, adding to speculation that even if a hike by the Bank of Japan is delivered just after the spring wage negotiations, the pace of subsequent hikes in Japan will be very gradual. Now, dollar yen could emerge above the key resistance zone of 150.80 soon, but it is very important to note that the higher this pair goes, the higher the risk of another intervention by Japanese authorities.
Geralambos, thanks so much. This was a preview video. Thanks for watching at xm.com.